I'm not suggesting that gold is going to move sevenfold or eightfold in the next 10 years. All I'm suggesting that gold historically has had really substantial upside, much better upside than people who don't read history have any sense of. When people today are excited about the fact that gold's 2,700, and I've said this on your show, I don't own gold because I think it might go from 2,700 to 3,000. I own it because I'm afraid it's going to go to 9,000 or 10,000 or some higher number. I don't know what a sevenfold increase from $2,700. I don't know what that number is. And I'm not saying it's going to go there, but I'm not saying it's not either.
Gold has long been regarded as a safe haven asset, favored by investors for its ability to hedge against inflation and provide stability during economic or geopolitical turmoil. However, the precious metal has recently gained increased attention as its prices have surged to record highs. Beginning in July 2023, gold futures saw a notable rally, opening at $2,411.70 per ounce and closing at $2,433.60, signaling a sustained upward trajectory. This rise in gold prices reflects heightened investor interest, partly driven by concerns over inflationary pressures and broader economic uncertainty. Legendary investor Rick Rule cautions that while gold has historically delivered strong returns, it is not without its risks. One notable example is the 1970s, when gold prices surged from $35 to $200 per ounce in response to economic and geopolitical tensions. A significant correction followed this rapid price increase as the Federal Reserve raised interest rates, causing gold's price to retreat to around $100 per ounce. Investors who sold during this correction missed out on the subsequent rally that saw gold prices climb to $850 per ounce. Rule underscores that such volatility is characteristic of gold markets. While it can offer substantial returns, market corrections can lead to significant losses for those unable to withstand short-term fluctuations. For investors using gold primarily as a hedge against inflation, Rule notes that even modest allocations have historically proven effective in preserving wealth. During the 1970s, gold's price surged from $35 per ounce to $850, representing an increase of more than 2,300%. Similarly, between 2000 and 2010, the price of gold rose from approximately $250 per ounce to over $1,750, reflecting a nearly sevenfold appreciation. Gold has thus demonstrated its value as a store of wealth during periods of rising inflation, economic instability, and currency devaluation. If inflationary pressures were to escalate to levels seen in the 1970s, Rule suggests that gold could reach $9,000 to $10,000 per ounce, further emphasizing its role as a protective asset during economic strain. Now, we present the clips of Rick Rule's insight.
I will say, too, that too many people who buy our narrative overinvest in precious metals. They invest so much of their net worth in precious metals that they can't stand the periodic price declines that occur in precious metals. I remember very well in the decade of the 70s, in the period, I'm guessing 1970 to 1974, early 1975, the gold price had advanced from an admittedly price-controlled $35 an ounce up to $200 an ounce. And of course, all the gold bugs were geniuses, Then the Fed raised the interest rate, and the gold price fell by half. The gold price fell from $200 to $100. It was a 9-month wipeout. And all those brave gold bugs, not all, but most, or at least many, turned tail and ran. What happened was, when the price action didn't justify the narrative in the short term, people's faith vanished, and there were wholesale liquidations of gold. The people who did liquidate, the people who didn't have the financial or psychological wherewithal to stay the trade, missed a move in the gold price from $100 an ounce to $850 an ounce. The point is that your holdings of precious metals or precious metals equities need to reflect A, your needs, but B, your psychological and financial stamina. If you are overinvested in the space, you are likely to get shaken out. The second thing that people need to understand in terms of position sizing around precious metals is that if you own them for insurance, a little bit goes a long way. If you look back to the decade of the 70s, forget about $35 an ounce to $850 an ounce. Let's assume that the move from $35 an ounce to $100 an ounce was recovery of ground that was lost during the period where the gold price was controlled. So let's just say at the beginning of the period that the free market price of gold should have been 100, and it went to 850. That's an eightfold move in the gold price. Fast forward to the decade 2000 to 2010. The gold price moved from $253 an ounce to $1,750. What's that, a sevenfold gain? I'm not suggesting that gold is going to move sevenfold or eightfold in the next 10 years. All I'm suggesting is that gold historically has had really substantial upside, much better upside than people who don't read history have any sense of. You know, when people today are excited about the fact that gold's 2,700, and I've said this on your show, I don't own gold because I think it might go from 2,700 to 3,000. I own it because I'm afraid it's going to go to 9,000 or 10,000 or some higher number. I don't know what a sevenfold increase from $2,700. I don't know what that number is. And I'm not saying it's going to go there, but I'm not saying it's not either. It seems to me the only way out of our fiscal and political impasse is to reduce the net present value of the promises that we've made to each other. The time-honored way to do that is inflation. The IRS, not some cranky old libertarian, suggested in the decade of the 70s the U.S. dollar lost 75% of its purchasing power. If that were to occur in the next 10 years, it's anybody's guess where the gold price might go. People also need to understand I might be wrong. You don't want to have a larger investment in precious metals than corresponds with your financial and psychological ability to take risk. A little bit goes a long way, but get that little bit.
With the Federal Reserve's ongoing efforts to combat inflation through interest rate hikes, many Americans are grappling with the impact of rising costs on their savings and investments. As inflation continues to erode purchasing power, financial experts warn that traditional investment strategies may not be enough to protect wealth over the long term. In response to these challenges, Rick advocates for strategically acquiring assets that can hold their value, such as gold and real estate, particularly for individuals nearing retirement or relying on traditional pension plans. Rick highlights that while inflation is a key concern, its effects can be mitigated by diversifying into assets that historically preserve value. Gold, in particular, has proven to be a reliable store of wealth during periods of high inflation, even if its short-term price fluctuations may deter some investors. Despite the potential for dips in gold prices, Rick believes the long-term benefits of holding precious metals and real estate outweigh the risks. He stresses that, as inflationary pressures persist, securing tangible assets can be a prudent strategy to safeguard retirement savings and protect against the growing risk of economic uncertainty.
Donnegan, I've been systematically buying physical gold since 1999. I don't need to buy more gold. I'm going to buy more gold, but the fact is I own lots relative to what I might need. Other people are less fortunate. Most of the American public, if pressed, probably couldn't spell gold. And I think they need to begin the process of systematic acquisition of gold, unless they have some other internal inflation hedge that works for them. In fact, with regards to my own circumstance, a good financial planner would look at my estate, being the largest shareholder of Sprott, and say, why do you own gold at all? If the gold price does well, the businesses that you own will prosper, and you'll win by proxy. I own gold because it's insurance. It helps me sleep nights and stay calm. Sleep is a good attribute if you're 71 years of age. So everybody's circumstance is different. For people who have their lives structured in a way that persistent inflation will be ugly for them, people with long bond portfolios, people relying on conventional pensions, particularly defined benefit pensions, I think they need to begin the process of the systematic acquisition of assets that are traditional inflation hedges. And they need to do it now. If the price of those assets falls, God bless. If I'm wrong, then your conventional pension will do a good job for you. But I would ask those people to consider the probabilities of what I've said, judge their actions accordingly. I have found myself, if you look at the whole of my net worth, the whole of my portfolio, I've found myself adding cash. It is not a deliberate strategy. I'm not trying to get liquid. I am already too liquid. What's happening is that some of my speculative bets and some of my investments have paid off. They've gotten to the point where they're no longer cheap, so I sell them, and I haven't been able to redeploy the money. It was interesting. I'm not trying to liken myself to Warren Buffett, but I listened to Buffett's discussion the other day about the cash holdings of Berkshire Hathaway exceeding $300 billion. And what he said is, I'm finding myself opportunity constrained. He isn't suggesting that the market's going to collapse. He is suggesting that when he looks to buy businesses in the size and of the quality that attracts him, that there aren't very many opportunities. At the same time, some of the existing businesses that he owned in a large measure, Apple as an example, Bank of America as an example, are at this price, relative to the earnings stream he sees them generating over the next 5 to 10 years, less attractive. He hasn't been a seller from a strategic point of view. He's been a seller from a tactical point of view. And I find myself in the same circumstance, albeit, sadly, with a couple zeros missing.
Gold has long been considered a safe haven asset, and its outlook remains strong, particularly due to persistent inflation and ongoing economic uncertainty. As inflation continues to rise globally, the demand for gold is expected to increase as investors seek protection from currency devaluation and the erosion of purchasing power. Some analysts predict that gold prices could reach as high as $9,000 per ounce in the coming years, driven by these inflationary pressures. Both Citigroup and JP Morgan share a positive outlook for gold, forecasting continued price increases if inflation remains elevated and if central banks, such as the Federal Reserve, maintain accommodative monetary policies. If the Fed keeps interest rates low to support economic growth, gold could become even more attractive as an asset that does not rely on interest yields, unlike bonds or savings accounts. Please share your thoughts on Rick's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.